Today, we're going to go over the most important question in the home buying process. How much house can you actually afford? The dream home can quickly turn into a financial nightmare if you haven't considered the true cost of ownership. So here's the deal. Pre-approvals are a great starting point, but they don't tell the whole story. In this video, we're going to break down the numbers, build your dream team, and by the end of it all, you'll understand how much ownership really costs and how much of it you can afford. Now, pre-approvals aren't the end, but if you've been pre-approved for a high loan amount, don't get carried away. Stretching your budget beyond affordability can lead to stress, limited savings, strained financial future, and strained relationships. So it's really important to budget, know all the before cost, during the transaction cost, and all the cost that's associated once you have the keys in your hands. Know your cost. If you don't have an understanding of your true affordability, you can't make responsible choices, leading to potential financial burdens and headaches causing delays. Now, I'll tell you, having knowledge definitely conquers stress. So when you have a realistic picture of your affordability, you can create a budget that works for you and your lifestyle. This actually includes room for savings and unexpected expenses. Putting that budget into practice will set you up on the path to long-term financial stability. So it's almost like if you were going to trade stocks and you wanted to get into it, well, don't just jump right into it. You want a paper trade, okay? See if you're going to win or if you're going to lose just by writing positions down, purchase positions and sell positions. So that's like a real deal scenario that you have to put into play with that paper trade. Now, let's talk about shifting your focus. Instead of looking at that pre-approval letter and saying, yes, this is good, everything's good on my loan, instead of how much I can borrow, ask yourself, how much can I comfortably fit into my budget? So you can actually create a sustainable strategy you can live with. This means applying for the amount that covers your cost approximately, and not just the one that gets you the pre-approval. So here's a perfect example. Imagine if you received a pre-approval letter for $500,000, but after analyzing your income, existing debts, and desired lifestyle, you realize the monthly payment would actually leave very little wiggle room for savings or unexpected costs. So by prioritizing affordability, you can actually adjust your search criteria and find a charming home for $400,000 that not only fits your family's needs, but fits your budget perfectly, allowing you to plan for the future without any financial worry. Now, before we get into numbers, it's essential to have a team in place. So we're going to go over your teammates, what they do, and importantly, how much they cost. When putting a dream team together, Phil Jackson, the architect of the dream team, said, hey, I wanted Magic, I want Bird, and I want Jordan. However, if you wanted all those high quality players, there's a cost that comes with it, okay? When building the dream team for your home, we want to know all the cost that goes into it so that you don't overpay for what you want to have delivered. So buying a home involves various experts. Having a strong team in your corner ensures a smooth and successful transaction, saving you time, money, and stress. So who's on your dream team? Let's go ahead and break this down. So the first person that's on your dream team is going to be the real estate agent. A real estate agent should be very knowledgeable, and they should be an agent that guides you through the market, negotiates the offer based on your best interest, and advocates for your needs. So here's a pro tip for you. Ask about their experience in the target area and commission structure, and you can actually negotiate a rate if possible. Other things that you want to know is how long they've been in business, how often they actually handle buyer side transactions if you're buying, and how often they handle seller side transactions if you're selling. And you have to make sure that they know the market, they know how to negotiate, and they're actually well known in the area, because here's a key tip, right? As a loan officer that's worked with hundreds and hundreds, if not thousands and thousands of real estate agents, the number one thing a seller is comparing offers. The listing agent is actually going to sway the decision of the seller based on their market knowledge and their knowledge of the loan officer as well as the realtor that is on the other side of your transaction. So the next person on your dream team is probably the most important person, and I'm not just saying it because I am one, but you need your mortgage lender. A trusted mortgage lender helps you understand loan options, pre-qualifies you, but most importantly, educates you on the true cost of home ownership. So don't be afraid to ask questions. As a loan officer myself, I get questions 7 days a week, sometimes at night, sometimes first thing in the morning, and sometimes even overnight, like at 3, 4 o'clock in the morning. It's really important to get quotes from multiple lenders to compare rates and fees, and don't just settle for the first offer you receive. Negotiate for a better interest rate, because we're actually in some tough times right now. Next person that's really important is a home inspector. Now, a home inspector actually identifies potential problems on your property, giving you valuable insight before making a purchase decision to avoid future maintenance issues. So here's a pro tip for you. Look for home inspectors with certifications, positive online reviews, and make sure that the certifications are actually relevant and they're actually active attractive. Consider getting quotes from a few before choosing one, and actually look up those online reviews to see if other people that have used the inspection services, not just the most recent ones, but maybe some of the older ones, will actually say, hey, you know what? This home inspector caught some things that I would not have caught with my naked eye, or the home inspector caught some things that the appraiser didn't catch, because the appraiser is not there to catch major issues, but they will catch some of the major safety, sanitary, and structural issues. However, back to home inspectors. Utilize coupon websites or ask your agent for a recommendation on inspectors with discount programs. Next person that you have to get is a real estate attorney or a settlement agent. And let me tell you the difference, okay? So a real estate attorney is optional. What the attorney can do is that they can review the contract, protect your legal rights, and offer additional peace of mind. However, I would say about 95% of the time, you're not going to need the real estate agent to get involved in these contract reviews or protecting your legal rights. A lot of times, a title company can actually do it for a lot less. An attorney may actually be essential in a complex transaction, but might not be necessary for all situations. Title companies sometimes cost less upfront and provide cost savings. So you have to start by researching and interviewing potential real estate agents, mortgage lenders, and home inspectors. Look for professionals with experience in your area and positive client reviews. Utilize online resources and professional associations to find qualified individuals, because that's going to make your process that much smoother if you have the dream team on your side. Now, let's go on to decipher the difference between a pre-approval and a pre-qualification. Now, a lot of first-time homebuyers get confused at the sight of a pre-qualification, mistaking it for a pre-approval. What's the difference? Well, a pre-qualification is a preliminary assessment of your borrowing power based on self-reported information. Think of it as an estimate of what we see. A pre-approval is a more thorough analysis of your finances by the lender, including verifying income, assets, liabilities, and credit scores. A pre-approval definitely carries a lot more weight with sellers as they demonstrate your financial strength, and the fact that your lender has actually reviewed all of your documents is definitely an A+ in everyone's book. It's really important to seek a pre-approval from a reputable mortgage lender, though. This actually demonstrates your financial strength to sellers and helps streamline the offer process. Let me give you an example of why a pre-approval from a reputable mortgage lender is important. So let's just say you're working with an agent, and the average agent and the average loan officer is going to be older, okay? When I first got into the business, the average loan officer was right around 55 years old, and the average real estate agent is probably going to be in their 40s. They've been in business for quite a while. That still holds true today. However, there's a lot more young influx, so that age has actually come down some. However, don't just settle for the first pre-approval you receive. Shop around for the best rates and terms. Know the differences between banks, lenders, and brokers. Review the NMLS number to see how long your loan officer has actually been in business. Use sites such as the NMLS Consumer Access site to look up any mortgage complaints and to see which companies your loan officer has actually worked with. Remember, not only shop around for the best rates, you have to shop around for the most reputable mortgage lender. Banks, lenders, credit unions, and brokers, here's the difference. When you're working with a bank, let's say a mega corporation, a lot of times you're actually just talking to a call center. And as someone that's been in the business as long as I have been in, that's probably the worst lender that you can actually go to. And the reason being is when you're in a call center, it's very high volume. And if there's any type of credit challenges or any type of credit issues, your file would actually not be looked at by a true loan officer until it's kicked down a lot further down the line. So when you're working with a call center rep, they're typically working with anywhere between 20 and 150 files at one time. You're going to get lost in translation. By that time, you get ratified, you give it to them. There's going to be a couple day delay to get the loan application in. Now they're working it through the team, and then finally the loan officer reviews it, and so does the processor. Any challenges come up, it could be a couple weeks down the line before you even find out. When you're going through that credit union, you're going to walk in, and once again, the credit union service representative may not be a true loan officer, or they may be a newer loan officer, because when you go through all that volume, you're getting that experience. You don't want to be experimented on. Now, you go to the lender. This is the difference between a lender and a broker, okay? You always look at those NMLS numbers, and there's almost 3 million NMLS numbers. The further you are or closer to the 3 million, that means you're a newer loan officer. And then the older numbers, such as the couple 100,000 ones, those people have been in business for a long time. So my NMLS number is 262139. So if you go onto the NMLS consumer lookup, you'll see that I've actually been in business for over 17 years, and that shows that, hey, I've got experience. Number two, the online reviews matter. It's not like riding a bike, okay? You can't just jump on and say, yep, I know how to do that FHA loan or that conventional loan, because guidelines are constantly changing. If you get loan officers out there that are only doing like maybe one loan a year or one loan every 2 months, they're not up to date with the guidelines. Whereas if you get someone that is actually doing loans all the time, maybe not a super high volume, but maybe mid volume, okay, at that point, you have someone that knows the guidelines. You have to check in on their team. How are they structured? Is it just the loan officer themselves? Is it a loan officer processor, loan assistant, anything else, okay? Because that does make a difference. Having the extra hands in the pot also means that there's extra eyes on your file to ensure that you get to the finish line. I shared with you my NMLS number, which is 262139. That's actually my proof of being in business for over 17 years as a loan officer, securing loans for client after client and helping the clients who can't get approved get back on track. That's why I'm here on this channel, telling you the same thing I teach each and every one of my clients and loan officers. So if you've learned something today, give this video a like. On my channel, I've got playlists and videos covering every type of loan and how to use them in nearly every type of situation. There's a link in the description for all of that and more. But for now, let's get back to the video. Now that we've got our team in place and we've got our budget together, let's get into assessing our affordability. Don't just look at the mortgage. Here's what truly matters when determining affordability. First thing is income. Always analyze your total income to include all the salaries, bonuses, and consider potential future changes like job promotions or potential career shifts. Debts, that's another thing. Factor in all of your existing debts, car loans, student loans, credit card payments, and their monthly payments. Remember, these will still need to be paid alongside with your mortgage. And when you look at the balance, you can see how many more months you're gonna have left to pay on these. Next thing to really consider is down payment. While a 20% down payment is ideal, explore options with your lender if a lower down payment is your reality. There might be loan programs or down payment assistance options available. Another thing to really look for is recurring expenses. Don't underestimate the impact of everyday cost, including groceries, utilities, transportation, insurance, that includes car, health, and any type of like life insurance that you have, and subscriptions in your budget. You have to know what you have to have and what you want and what you need and get rid of the wants. Next thing is lifestyle choices. Do you prioritize travel, dining out, hobbies, or sports? Ensure your mortgage payment allows for these activities without sacrificing your financial security. It's really important to create a detailed budget to understand your income, expenses, and savings goals. Budgeting tools and online calculators can certainly help visualize your affordability, but you should always factor in a buffer of 5 to 10% in your budget for any unexpected expenses, because guess what? Life happens. First thing we're going to do is calculate your debt to income ratio, which is really simple. Start with your gross monthly income. This is your income before taxes are taken out. Let's just go ahead and use $10,000 into this example. We're going to then add up all of your monthly debts. This includes your proposed mortgage payment, car payments, student loans, credit card bills, and any other recurring expense. In this example, let's just say that your total monthly bills come to $4,500. At that point, when we are calculating your debt to income ratio, we are going to divide your total monthly debts by your gross monthly income. So in our example, it would be $4,500 in debt divided by your income, which is why it's called debt to income ratio. And at that point, we're going to figure out that it's 45%. So it means that you have a debt to income ratio of 0.45. Remember, you should also factor in savings and retirement contributions. Savings is a set aside money for emergencies and future goals. However, in retirement plans, because we've accumulated this tax-free over time, contributing to a retirement account actually allows your money to grow tax-free and can come with employer matches. If you're not taking advantage of these benefits, it could really mean that you are missing out on free money and long-term growth. By considering all of your financial obligations, you can actually make informed decisions about your spending and your future financial security. So let's remember, the house itself isn't the only expense. Here are some hidden costs to consider. First thing is property taxes. It may or may not be included in your mortgage. However, you really need to research typical property taxes for your desired areas. Because like in my city, we have 7 cities around us, okay? And we have taxes that can go as high as $1.40 per $100. And then we have taxes as low as less than 60 cents per $100. These can vary significantly and add to your monthly housing costs. Next thing to consider is homeowners insurance. Now, we all know we've gone through some inflation recently. And guess what? Homeowners insurance has also gone through some inflation. You have to factor in homeowners insurance costs, and these are going to vary based on location and property value and the risk based on the condition of the property. Maintenance and repairs is really important. So this is now getting into the post-closing. Owning a home actually comes with unexpected repairs and maintenance costs that you can't just call your landlord up on and have them go fix it. Plan for a buffer in your budget for these expenses. Here's a money-saving tip I want to offer you. Consider a home warranty to help cover some of the repair costs in at least your first year of ownership. When you are buying a new house and you have visited the house, and let's just say you spent 2 hours visiting the house, then you spent another 5 hours, which is, I'm totally over exaggerating this, on a home inspection, and then you spend another 2 hours on the final walkthrough. So at that point, you've spent spent a total of 9 hours looking at the house. Do you think you're going to be able to catch every single quirk in the house? Probably not. So when you start spending 12 hours, 18 hours, sometimes even 24 hours in the same house, you're going to start noticing different sounds. You're going to start noticing things that don't work. And this is where the home warranty definitely comes into play, because I'll give you an example of a home warranty claim that I recently claimed. And that was a replacement of my 35-year-old Trane outside AC system. If I didn't have the home warranty, I probably would have paid close to $5,000 to replace the outside unit, and then maybe another $3,000 to $4,000 to replace the inside unit. But because I had the home warranty, everything kicked out. It was $900. The savings actually paid for over 10 years of home warranty for me. So I'm a big believer in getting home warranties, not just for the first year, but for the term of my home ownership. The other thing to really budget for is private mortgage insurance. You noticed I separated the difference between homeowners insurance and home warranty, and this is why. It's not the same thing. A home warranty covers any like electrical, plumbing, appliances, maybe a roof repair, your HVAC system, and other things that you can potentially add on. So my mother has a pool. She has a saltwater pool pump coverage. We tailored it specifically to her needs. However, homeowners insurance is totally different. It's included in the mortgage, but the first thing that it protects is it protects you against a total loss. So if your house burns down, if there's an issue with like wind and hail, if you have that coverage, then that homeowners insurance will cover the cost to rebuild it, because you're still going to have the mortgage if that happens. Homeowners insurance also covers liability, and then there's an optional coverage of any goods that you have, like if you have diamonds or if you have any precious metals that you want to protect, that can be covered as well. But there is a part in the homeowners insurance that will cover major system failure, and that's mechanical breakdown. It's a very little cost, and having that in conjunction with home warranty is definitely an A+ in my book. Now, let's go ahead and talk about private mortgage insurance now, which is PMI. If your down payment is less than 20% and you're getting a conventional loan, you may be required to pay PMI, which adds to your monthly expense. You have to research everything, okay? Research the estimated property taxes, homeowners insurance cost in your target area. Talk to your lender about different PMI rates, because every lender is going to have different PMI rates. Set aside a portion of your budget for home maintenance and repairs if you're not going to get the home warranty or mechanical breakdown in the homeowners insurance. So if you're considering a down payment less than 20%, factor in PMI costs. Now, PMI is going to vary, okay? There's the standard PMI that everyone knows about, which is a monthly charge on your mortgage. There's also a split premium, which splits it just like FHA, okay, with an upfront premium and a monthly premium. Then there's a single PMI that totally buys out the monthly factor. And then here's the kicker. There's also lender paid PMI. If your credit score is high enough and there's a premium that we can use, which is the lender credit, we can actually use that to actually buy out your private mortgage insurance. It's really important to not only explore the PMI factors with your loan officers, and I'll tell you, with me doing it this many years, I would say I can count on at least two hands the amount of transactions that I was able to save customers money because their loan officer did not know the differences in PMI or compare it to an FHA loan. Now that we've gotten that out of the way, let's explore the home warranty options with your real estate agent and or mortgage lender to see if it fits your needs so that you can have that on your closing disclosure when you go to closing. Here are the key takeaways that I would like to discuss with you. Number one, the negotiation strategies. Why negotiations matter. Negotiating an offer can save you thousands on the purchase price of your home or out-of-pocket expense, and every dollar counts nowadays. Preparation is key. Research average sales prices in your area, get comparables from your real estate agent, understand your budget limitations, and be realistic about your offer. Because I'll tell you right now, I talk to listing agents all the time, and those super low ball offers are 9 times out of 10 just getting straight up rejected. And it's really important to consider all costs. Remember, those hidden costs that we discuss, factor them in when negotiating a price. A lower purchase price may allow for more wiggle room in your budget for future expenses. This is why it's really important to work with your agent hand in hand. So I always tell my customers, I'm married to you as a loan officer. Now you should also be married to your real estate agent. Your real estate agent should be able to guide you through the negotiation strategies and present you with comparables, pending sales, as well as sales that have happened in the last 12 months so that you could come up with the best offer for the property that you are interested in. Don't be afraid to get creative. Consider closing cost assistance, which is a request that the seller contributes to some closing costs, reduce the upfront financial burdens, and even cover prepaids. When you're writing this part into the contract, it's really important to say this verbatim. Seller to pay X amount of dollars. The reason that dollars is important because that dollar amount can be negotiated and it won't change if the appraisal comes in low if you negotiate a percentage. The seller to pay X amount of dollars to be used for closing costs, prepaids, and or as lender guidelines permit. I've seen it too many times when a percentage is written in, that appraisal comes in low, we get less. I've also seen seen it where a real estate agent has written 4% of the closing cost. Woo! Big blooper there, okay? Because 4% of the total closing cost is not going to make you a happy camper. So let's now talk about repair credit. If the home inspection identified repairs, negotiate for the seller to actually cover the cost of the repair or contribute closing cost in lieu of the repair cost. Let's talk about the home warranty a little further, okay? Explore the possibilities of the seller including a home warranty in the sale, potentially saving you money on repairs in the first year of home ownership. Remember to discuss negotiation strategies with your real estate agent. Be prepared to walk away if the seller's counteroffer doesn't meet your budget needs. So let me give you an example of what I went through when I bought my most recent house. I fell in love with this house because of the school district, everything. I mean, every box was checked. You know, it was close to a hobby that I really like, you know, it was surrounded by lakes, but I felt like the asking price was a little high. So I worked with my real estate agent and she actually researched all the comparables of sold listings in the area and talked to the listing agent about, you know, potential repairs that are. Well, after getting all the research and recon back, we presented a well-reasoned offer that was below asking price. I didn't hit them too hard. I said, look, I really like your house. However, this is all I'm willing to offer for it. I highlighted the actual factors that came into my decision-making process, and I requested that the seller actually covers a portion of the closing cost, including dropping the price a little. And this also included the home warranty in my sale. After some negotiations, the seller accepted my offer with some closing cost assistance and the 1-year home warranty credit. At that point, it saved me money and I was able to choose the home warranty company that I wanted to work with. And in turn, it actually offered me that peace of mind for the potential repair of a 30-year-old HVAC system that I had and my old water heater that was rusting at the bottom. So by asking for the home warranty in lieu of the repairs, the total out-of-pocket expense for everything that I put in for the water heater as well as the HVAC system was $1,500. If I were to get the water heater changed out, today's price is about $2,000 for the same water heater. Okay, not a tankless or anything. It's just a big old water heater that has the new digital display on it. And then the outside and the inside HVAC systems would have cost me close to $8,000. Between the deductible and the cost, I saved thousands and thousands of dollars. Let's recap this video. It's really important to prioritize pre-approval amounts and don't get stretched thin. Consider all of your expenses, not just the mortgage payment, and create a detailed budget. Next thing we want to prioritize is understanding your income, expenses, and savings goals. Don't underestimate all the other costs, such as groceries, utilities, and etc. Build a dream team for a smooth and successful and affordable transaction. Get a pre-approval to strengthen your offer, but shop around for the best rates, and be prepared to negotiate and walk away if necessary. Still have questions about buying a home or navigating the mortgage process? Don't hesitate to reach out. Leave a comment below or schedule a free consultation with me using the link in the description below. Additionally, if different loan types pique your interest, I've got a playlist covering every loan type in the description as well. Thanks for joining me today. Remember, buying a home is an exciting journey, but remember not to get swept away in pre-approvals covering high price tags. Careful budgeting that covers the cost, not just of buying the home, but owning the home will save you time and money in the long run. Now that you've finished this video, you're well on your way to achieving your dream of home ownership. Happy house hunting. David Zai, Mortgage Guy, and I'm out.